Hello value investors, thank you for joining me. Today we're going to talk about Avalara and why I don't see much opportunity here for new shareholders. We'll talk about the company, its market cap, we'll talk about its end markets as well as its total addressable market. We're going to focus on its near-term revenue growth rates, and we're going to bring it all together talking about its valuation. But before we get started, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns, where I'll tell you which stocks I own and why, with balanced arguments for the stocks I own. There you'll see different types of stocks, some that are high growth, some that are low growth, and hopefully if you do a free trial, you'll see something that suits you. So let's get started. So Avalara has pretty much focused on calculation and returns of tax rates and making really compliance quite easy. It puts its total addressable market at approximately $8 billion in the United States. This comes from emerging small businesses, mid-market, and enterprises. So as the world digitalizes, there's a very strong opportunity. If you remember, companies are starting to do more e-commerce across states in the United States, across borders internationally. So this is really a way for businesses to become more efficient by taking up their products, Avalara's products, and really simplifying the whole process. So it does have a lot of potential. One thing that I will note is that its revenue growth rates are really kind of starting to tail off. So back in 2019, it was growing really strongly. You can see here, it was frequently hitting 40% year-over-year growth rates. In 2020, we are facing this very steady decline of year-over-year growth rates. For a SaaS business model, this is quite concerning because the whole idea behind investing in a SaaS business model is that you should have very steady predictability in the company's revenue growth rates and strong visibility. This is not the type of visibility you want to be facing. So during the earnings call, management talked about Q2 being strong, possibly because there's a lot of pent-up demand from Q1, from the March, April, when the economy kind of slowed down, a lot of those deals falling into June. But as you look out here, Q3 is coming down, and Q4 particularly is looking at revenue year-over-year growth rates coming at 16%. And I was like, wow, this is quite a slowdown. So I just did a sanity check, and I just checked an analyst looking at a similar growth rates. So it reinforces the picture that this company was growing quite strongly, but it's guided to grow at not such a strong rate. As a brief aside, management talks about its net retention rates, its ability to upsell to customers at 107%. So this is the lowest level it has seen. If you bear with me a second here, I'll just find it. So this is the lowest level it has seen for several quarters, with the only difference being here one in September 08, where in Q3 it was 105. But for a while, this has been really kind of the slowest net retention rate. For a company that is being priced in the SaaS world at slightly more than 20 times forward multiple to sales, this is quite a punchy multiple. So if you think about it, right? So any company that was being viewed as a SaaS company, when we came out of the March, April sell-off, any company that was in the tech world was being viewed as cloud facing, was getting that blanket multiple of 20 times forward sales. Now, presently, investors are starting to question. We saw this in the last couple of weeks with Zscaler reporting, PagerDuty, and Slack. All these companies, from my perspective, reported quite strong results. But the market was like, enough is enough. We're not going to be paying crazy multiples for this type of company anymore. So these are the big headlines that were reported in the last couple of weeks. So I don't really know how, when Q3 comes up in October time, the earnings season, I don't know how the investors are going to be looking at companies, but these were the big bellwethers reported in the last couple of weeks, and investors was like, nah, this is enough, we're not going to be paying this kind of multiple anymore. So in the case of Avalara, it's really it's been priced to a market cap of 11 billion, and if you think about it, its revenues, after it revising upwards on the guidance for its revenues is going to be 470 million, and is still expecting to be burning through cash flow. So you have a company that has negative operating losses guided for, burning through cash, 470 million, and investors are having to pay 11 billion markup. So this is a very punchy valuation for a company that's decelerating its revenue growth rates. I'm struggling to see how a new investor, a new shareholder could come here and expect to see any more upside potential. It's not likely to be coming from the multiple expansion, because already trading at 21 times, close to 21 times forward revenues. So it's not coming from the multiple expansion. It's definitely not coming from revenue growth rates are accelerating. So I'm just struggling to come to terms how investors are likely to see any further upside potential. In any case, hope you found this video useful. Don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns, where I'll tell you the stocks I own and why, with balanced arguments for the stocks I own. And I'll tell you the best stocks to own for strong upside potential. Thank you for listening. See you next time.